Welcome to the October Loan Market Overview clip. I'm Steve Miller, a member of Standard & Poor's Leverage Data and Commentary Team, a unit not part of S&P's ratings agency. For the next 5 minutes or so, I'll walk you through a review of recent loan market trends before winding up with some themes to watch for in the fourth quarter. For real-time updates on the loan market, please follow LCD on Twitter, Facebook, and LinkedIn. As well, you can download this presentation on slideshare.net. You've all seen this before. It's a disclaimer. Please read it at your leisure. The loan market returned from the summer break with a head of steam. Bolstered by strong inflows into the retail funds and a slew of bond takeout deals, loan prices rallied, pushing the S&P LSTA index up 1.4% in September compared to a 34 basis point increase in August. In the primary market, supply jumped to a post-Lehman bankruptcy high, yet failed to keep pace with demand. Clearing yields therefore contracted about 50 basis points from August levels, with the decline intensifying at month-end. September's big pop of volume round down the forward calendar to $15 billion at the end of September from $18 billion a month earlier. Most participants still expect a very busy fourth quarter, though October may be a bit of a lull. The default rate was steady in September, inching to 3.6%. In October, the rate is poised to fall inside of 3% for the first time since November 2008. With demand outrunning supply, loan prices rallied in September. LCD's flow name composite, shown here as a sample of the 15 largest names in the market. The composite stood at 95.1 on October 5th, up about 2% from a month earlier and within sight of the post-credit crunch high from April. In the primary market, too, the pendulum swung in the direction of issuers. On average, new issues printed at 7.2% in September, down from 7.9% in August. Over the past 2 weeks, what's more, the average clearing yield fell to 6.7%, close to the first quarter lows. Pricing fell across the board, with the center of gravity for spreads falling 50 basis points, LIBOR floors generally tightening to 1.5% from 1.75%, and OIDs moving up about a half a point. This chart shows the return by month of the S&P LSTA loan index. As mentioned before, the index was up 1.4% in September after eking out a 34 basis point gain in August. Over the first 9 months of 2010, loans have returned 6.8%. That compares to a gain of 11.3% for high yield and 3.9% for the S&P 500. In September, with the bulls running, single B loans outperformed double B loans 1.8% to 1.1%. As this chart demonstrates, volume popped in September. Arrangers rolled out deals as fast as they could to take advantage of strong demand. Still, with repayments running strong, the pool of outstanding term loans contracted slightly in September. Declining supply in combination with bountiful inflows into the loan mutual funds drove up secondary prices and drove down new issue clearing yields. Default rates were steady in September at 3.6%. That's down significantly from the all-time high of 10.6% from just 10 months ago. Looking ahead, the default rate seems likely to step down significantly over the next 30 days as the big default class of October 2009 falls from the 12-month rolls. By year-end 2010, the default rate is headed towards 2%, about 1.5 points inside the historical average. To wrap up then, some final points. Participants expect a strong and steady flow of new issues in the fourth quarter, with issuers putting an emphasis on dividends and mid-cap LBOs. Demand from this paper will come largely from crossover investors and proceeds from bond takeouts. Up the credit curve, banks have worked up a hearty appetite as well for double B loans. Retail inflows remain an important source of liquidity as well. Through September, investors have poured $9.7 billion into the prime funds, according to Lipper FMI. Finally, default rates appear likely to push lower in the month ahead, most likely into the 2% range in October and perhaps as low as 1.75% by year-end. Certainly, the inventory of wounded issuers is low at the moment as a result of 4 successive quarters of year-over-year EBITDA growth. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description of this video below. As mentioned, you can also download this presentation at slideshare.net. Please check in here next month for an updated clip.